welcome to this quarter's House View update from Asset Intelligence. Last quarter I told you that the buzzword of the moment for investors was inflation, and as we stand here in April, that is still the case. But the I word has been joined by some others of late, words the likes of which most investors haven't had to wrestle with for some time. Words like invasion, airstrikes, siege, chemical, and even nuclear. This remains a time of extreme uncertainty on many fronts, the economic as well as the geopolitical. In circumstances like these, it wouldn't be prudent to try and align entire portfolios for one outcome or the other. The chances of error and unforeseen developments are simply too great. Broad diversification remains the order of the day. However, led by our investment director, Tony Mee, the team here at AI continue to monitor developments closely and to work through what the implications of these are likeliest to be for capital markets. And recent events have seen them make some positioning changes to our house view for the new quarter. First off, our overall stance on growth assets has been cut from +1 on our -3 to +3 scale to neutral. While equities remain the most attractive primary asset class on a fundamental basis, there is no doubt that the invasion of Ukraine has brought with it a series of tail risks for investors which simply were not there a few weeks back. In addition, the fact that inflation is now outstripping wage growth could slow economies down and so crimp equity returns over the months ahead. Next, it will probably come as little surprise that our view on the landscape of defensive assets encompassing fixed interest, cash and low beta alternatives has been upgraded to neutral. The surge in inflation undoubtedly poses a stiff challenge to the fixed interest complex, but it remains the case that quality bonds are one of the most reliable diversifiers of equity market risk when serious downturns occur. Similarly, cash offers both protection and the opportunity to buy assets at lower valuations should a sell-off occur. So this is a change which has been made on the basis of potential protection rather than fundamental attraction. But at a time like this, that's an objective which rightly rises in priority. Let's turn now to the individual equity markets. Kicking off, our position on Europe has become less favourable for the straightforward reason that this is the region most exposed to the fallout from the conflict and the associated risks to energy supply. Surveys have already shown considerable hits to consumer confidence in key countries. So the score here is cut from neutral to -1. Our view on Japan has also been downgraded this time round from +1 to neutral. Despite its reputation as a safe haven during times of trouble, the yen has been weak of late, depressing returns for overseas investors. With most developed markets now looking to increase interest rates, yet Japan intent on keeping policy easy, this weakness could be set to continue. However, the news is more positive on the UK, where we've upgraded our view from neutral to +1. The revival of the market's interest in value stocks and sectors is now arguably seeing the potential of the FTSE's attractive valuations unlocked after a long wait. Well, that's all from me. If you'd like further information or have any questions about our views, please do get in touch. Thanks for watching.